Good afternoon, ladies and gentlemen. It is my pleasure to welcome you to the IPS-Nathan Lecture series by Mr. Piyush Gupta, our 17th SR Nathan Fellow for the Study of Singapore. Today, Mr. Gupta will be delivering his third lecture titled, The Future of Finance, How Singapore Can Continue to Punch Above Its Weight. Following his lecture, Mr. Piyush will take questions from the audience in a Q&A session. The Q&A session will be chaired by Mr. Caesar Sengupta, CEO and co-founder of Arta Finance. Before we begin, please allow me to go over some housekeeping rules for the event. Thank you for joining us at the auditorium today. Please be reminded to switch your mobile phones to silent mode. The lecture is being streamed live on IPS Facebook and on the Business Times Facebook and YouTube channel. It will also be recorded and uploaded onto our IPS website and YouTube channel later. Please submit your comments and questions at any time during the lecture via the YouTube live chat or Facebook comment box. For our audience members here at the auditorium today, please step up to the mic during the Q&A session to ask your questions. We would also like to hear your views on the event. There will be a QR code on the screen and a link in the feed at the end of the lecture to submit your feedback. Ladies and gentlemen, without further ado, I would like to invite Mr. Piyush Gupta to begin his third lecture titled, The Future of Finance, How Singapore Can Continue to Punch Above Its Weight. Mr. Gupta, please.
Ladies and gentlemen, good evening. It's a pleasure to be able to be here to do this third lecture. And the pleasure is not because it is the final lecture. It is because I really am quite deeply interested in this subject. Some of my commentary and views today are a little bit, shall I say, forward-looking. And so I hope to be able to share and excite you with some of the possibilities. Also, my starting caveat, even though the lecture series is for the study of Singapore, the first, almost a third of today's lecture is really explanatory. It focuses on trying to explain some of the basic concepts. And I thought long and hard about whether it was appropriate to do that. I just figured that for me to be able to make the rest of the lecture relevant, it would be important and useful to level set a bit. And so I've taken the liberty of doing that. So without further ado, I'm going to start with going back in history. In my previous two lectures, I discussed how Singapore's financial sector liberalization paved the way for a more modern and open financial system, and how the rise of fintech has reshaped the mix of financial players, as well as the type of financial services offered. Central to these waves of transformation has been the role of technology. Indeed, over the past decades, digital technology has transformed the banking landscape in far-reaching ways. Today, 97% of money in circulation is digital. Looking ahead, what does the future of money hold? A look back at history tells us that the nature of money follows technology shifts. You can see from the slide. Over time, money has evolved from commodities like cowrie shells to metals like gold, silver, copper, to paper, to plastic, and QR codes. In fact, even the form factor of value could also change as technology evolves. Already it has. You take REITs, for example. Today, a building can be fractionalized and distributed in the form of REITs. While the fundamentals of money, the ability to store and transfer value and to earn a return by putting money to work, have remained constant over time and are likely to hold going forward, what can certainly continue to evolve is the form of money through new digital avatars, as well as how it moves. With the rise of blockchain and distributed ledger technology potentially disrupting the traditional hub-and-spoke models of money movement. Technologies such as generative and agentic AI could also transform the way consumers and businesses transact. To understand these possibilities, in this lecture I will first discuss how money derives its value, how blockchain technologies work, and some alternative forms of money this has already created. I will then explore Singapore's response to these global shifts and offer some thoughts on how Singapore can seize opportunities to continue punching above our weight on the global financial stage going forward. So money, let me start by discussing what money is and how it derives its value. Money does not have any inherent value. Rather, it derives value only from the collective trust that people have in it. Money serves three functions. It is a medium of exchange, it's a unit of account, and it's a store of value. As a medium of exchange, people need to trust that they will be able to exchange it for the same value of goods or services. As a unit of account, people need to have confidence in how much they can buy with it. That is, they need to trust that prices will remain stable. As a store of value, people need to trust that money will maintain its purchasing power over time, allowing them to save and store wealth for the future. Trust also underlies the singleness of money, where all forms of money, be they cash, bank deposits, or digital currencies, trade at the same value with each other. In the modern two-tier monetary banking system, M1 money supply comprises physical currency and demand deposits, while M2 and M3 flows include M1 flows plus other forms of bank deposits. These money flows thus derive their value from the trust that people have in the government and in the central bank, as well as in commercial banks, which serve as trusted guardians of financial activity, whether in safekeeping deposits, extending credit, or facilitating payments. These monies are called fiat monies because they're born of regulation. The Latin word fiat means let it be done. Their value does not come from a physical commodity like gold or silver, but from the trust and confidence that people have in the issuing government, and depends on factors such as the country's economic performance, governance, and monetary policies controlled by central banks. While trust thus oils the flow of money, the current forms of establishing trust do have some weaknesses. For one, components of trust may at times break down due to a lack of faith in the government. In certain countries, for instance, the value of local fiat currencies is not trusted by citizens, as these nations face hyperinflation, where prices may rise several times daily, thus eroding the value of money. The other problem stems from the fact that every country has its own fiat money. In the cross-border payment space, the lack of universal recognition for currencies across countries has resulted in a hub-and-spoke model, where currencies flow through a network of correspondent banks. Each participant in the network waits to confirm that they have got paid before transferring the money forward, a problem arising from lack of trust in the sanctity of the payment instruction. As a result, the flow of funds through multiple intermediaries could result in delays and a lack of transparency in payment timelines and fee structures, as well as in fraud risk. Now, the emergence of blockchain and distributed ledger technology has offered an alternative method to establishing trust. In a blockchain, transactions are grouped into blocks, each containing a cryptographic hash of the previous block, a timestamp and date forming a chronological chain. This linking ensures that altering any block requires changing all subsequent ones, needing network consensus, which makes the system tamper-resistant. Nodes on the network verify and add new blocks through mechanisms like proof of work or proof of stake. The ability of all participants on the network to view every transaction provides greater transparency and reduces fraud risk. So this is trust not based on faith in institutions, but based on an underlying technology. Enabling trust through blockchain technology confers several advantages. Transactions are done through tokens, which allow the real-time simultaneous exchange of two assets and the exchange of information and value to happen in a single step, thus eliminating settlement risk and increasing the efficiency of transaction processing. Second, tokens can be programmed. This programmability through smart contracts allows transactions to be performed once predetermined conditions are met, thus facilitating greater automated and transparent processing. This in turn enables greater efficiency in executing contracts and reduces the risk of human errors. Third, tokenization allows fractionalization of assets, which democratizes access by investors to illiquid, high-value assets. One obvious advantage of blockchain technology is that it can enhance current cross-border payment and settlement systems by allowing funds to be tokenized and sent in real time to end recipients, cutting as much as 2 days out of the process. Partior, which is a blockchain-based network for real-time cross-border money transfers, which was set up by DBS, JP Morgan, and Temasek, is a good example of this. With digital compliance processes and smart contracts, payments could also undergo automatic anti-money laundering and know your customer checks. So far I tried to explain how money needs trust, and I've tried to explain how trust can be created through blockchains instead of just created by institutions. Now, moving on, the rise of this distributed ledger technology has led to the emergence of several types of digital currencies that can be classified across a spectrum, ranging from public digital currencies such as central bank digital currencies or CBDCs, or this example of blockchain, right? On the one hand, to private cryptocurrencies on the other end. In between lie tokenized deposits, which represent bank liabilities in a tokenized form, and stable coins, which sit between tokenized deposits and cryptocurrencies. While tokenized deposits represent private currencies, they're tightly bound to public money due to the fractional reserve system and the regulated nature of banks. So I'm going to spend a few minutes talking about these 4 different types of alternative currencies. First, central bank digital currencies, CBDCs. So let me start with that. CBDCs can be classified into retail and wholesale. Retail CBDCs are a direct liability of the central bank. The central bank could either create a direct account for each citizen on its own books, or alternatively, go through the fractionalized reserve mechanism of the extant banking system. The disadvantage of the former is that it could disintermediate the current banks entirely and put the onus for credit creation in the hands of the central bank. It could also amplify bank runs, with people switching from their bank deposit to the CBDC account in the event of any uncertainty. Nevertheless, there are advantages to an intermediated retail CBDC, which does not have the same kinds of risks. Wholesale CBDCs are used to settle transactions between banks, central banks, and other financial institutions, and can include new tokenization enabled functionalities such as programmability. Now, there have been a few CBDCs. So some central banks have already started issuing CBDCs. The question, are we likely to see a lot more? It's a distinct possibility, with 91% of central banks in the world currently exploring some form of CBDC. According to the Bank of International Settlements, 24 central banks across emerging and advanced economies are expected to have digital currencies in circulation by 2030. Currently, 3 central banks have launched a live retail CBDC in the Bahamas, in Jamaica, and Nigeria, while 55% of central banks in advanced economies are either running wholesale CBDC pilots and/or developing a live wholesale CBDC. Based on a similar BIS survey, nearly 75 to 80% of central banks working on CBDCs see preserving the role of central bank money as an important reason for potential CBDC issuance amid the decline of cash use. Key motivations for retail CBDCs include improving domestic payments efficiency and safety, as well as enhancing financial inclusion, especially in emerging markets, while wholesale CBDCs tend to focus on improving cross-border payments. An additional benefit is that a CBDC could be programmed to determine things like when and where it can be used. For instance, DBS partnered with the Singapore government to pilot using purpose-bound money. Essentially, these were vouchers issued using tokenized Singapore dollars to facilitate real-world transactions. This enabled instant payment and collections for businesses while allowing the government to retain control on usage, much like they do with traditional vouchers. So that's the extreme left, the CBDC story. Let me talk quickly next about the next form of currency, which is tokenized deposits. An alternative digital currency that has emerged is tokenized deposits, or digital money issued by banks. This refers to savings or checking accounts that have been converted into digital tokens and represent deposit claims against a commercial bank. Benefits of tokenized deposits include increased liquidity, as funds can be easily and efficiently transferred, providing investors with greater liquidity than traditional bank deposits. Deposit tokens also allow for instant atomic settlement, which can speed up transactions and reduce or eliminate counterparty risk. Programmability with smart contracts allows automation of a range of functions such as interest payment, collateralization, or loan origination. Deposit tokens could also serve as a new form of cash collateral for both traditional and digital asset markets. This may enhance intraday liquidity by enabling real-time and automatic collateral movement as trades can be completed within a day. Now, several banks such as DBS, JP Morgan, and HSBC have already launched tokenized deposit solutions, enabling real-time instant settlement and intergroup liquidity management for customers on a 24/7 basis. One of the challenges with tokenized deposits, though, is that they tend to be specific to individual banks. The interoperability of tokenized deposits is still a little bit of a challenge. Let me move next to privately issued money, and I'm going to start on the extreme right with the cryptocurrencies. So the main difference is the first two forms of money, CBDC and tokenized deposits, is money which is issued or created by existing players. The ones on the right are monies which are created by new players. As I explained earlier, the advantage of a blockchain is that you do not have to be a public or a government entity to garner trust. And recognizing this, various private entities began to issue private digital currency. The growth of privately issued digital coins such as Bitcoin and Ethereum is now well known. The fact that total market capitalization of cryptocurrencies exceeded $4 trillion just a few weeks ago before the big crash. You should remember that the total value of gold in the world is about $12 trillion. And that's after 1,000 plus years, 1,500 years. In less than a decade, cryptocurrencies were almost one-third the size of the gold market. That tells you how quickly cryptocurrencies started getting adopted. In fact, they were getting adopted so rapidly there started speculation that private monies could become ubiquitous and even replace public monies. This could create money that was accepted by everyone across borders and thus theoretically simplify payments and trade. This is the power. This is when Facebook was trying to launch its own currency, or the power of a Bitcoin, is that now you're no longer limited to each country is doing their own. There is a common currency which can be used by everybody in the world. So there is some compelling logic for having a common universal currency. Are we likely to see such a future where private monies replace public monies? The answer to this is probably no. This is because privately issued coins currently function as a store of value, much like gold is today. However, they do not adequately serve as a unit of account and medium of exchange due to a lack of ubiquity, absence of faith in the issuer, and large volatility in value, among others. Elon Musk famously, about a year or 2 years ago, said he would start accepting payments for his car in Bitcoin. He changed his mind a week later because the value of the Bitcoin moved so much that the value of his car fell by 40%. Regulators and politicians will also be loath to give up control of monetary policy and economic management tools and will therefore be very circumspect about letting private money grow. So, category 4, stablecoins. That said, one type of digital currency that has rapidly gained traction and could fulfill the role of money as a medium of exchange is stablecoins. Stablecoins aim to maintain a stable value through one of two ways. A, pegging their value to a stable reference point such as a fiat currency, assets or other cryptocurrencies, or B, using algorithms to adjust the supply of stablecoins. Today, most stablecoins are backed by fiat currency, with US dollar denominated stablecoins accounting for 99% of the global stablecoin market. In contrast to cryptocurrencies such as Bitcoin or Ethereum, which tend to see volatile fluctuations in values, stablecoins are, as the name suggests, a relatively stable medium of exchange. With the ability to serve as a means of payment and store of value, stablecoins could improve current payment systems, especially cross-border payments, by enabling faster processing and lower fees. They also serve as a bridge between real-world fiat currencies and cryptocurrency markets by allowing investors to trade in these markets without having to convert to fiat currencies. Today, stablecoins are used primarily for crypto transactions, with an estimated 90% of stablecoin transaction volumes coming from crypto trading. That said, the use as a form of payment is growing rapidly, especially for cross-border payments, largely in emerging market economies with volatile currencies. Now, I said stablecoins are more stable. Still, there remain risks. First, there are concerns over capital flight into US dollar proxies, especially given the dominance of the US dollar in the stablecoin market today, which could impact financial stability and monetary policy management. For instance, Standard Chartered actually estimated that up to $1 trillion in deposits could leave emerging market banks and move into US dollar stable coins in the next 3 years or so. And I must point out the geopolitical implications of this. Today, around 70% of global flows are denominated in US dollar, making it the global reserve currency and affording the US enormous financial clout. Right, I thought I had a slide on this, but I don't. This clout has been visible in the freezing of Russian assets at the start of the Russia-Ukraine war, for example. It is obvious that countries would prefer a more balanced currency utilization and payment systems that do not allow them to be held hostage to individual government whims. If the world were to migrate to significant use of US dollar stablecoins, the situation would get even worse rather than getting better, because US dollar stablecoins constitute 99% of global issuance. The only alternative would be for countries to issue their own stablecoins, but except in a few cases, these are likely to be for domestic use only. A second risk is that despite the name, there are concerns over the stability of stablecoins. A stablecoin is designed to maintain a 1:1 peg with a stable asset, such as the US dollar, by being backed by reserves or collateral. However, a liquidity run could occur if the stablecoin's collateral loses its value. That is, where holders of the stablecoin are not able to redeem the full dollar value of the coin. Third, stablecoins are becoming a tool for financial crime. So since 2022, stablecoins have overtaken Bitcoin in its use in criminal activity, and as of 2024, accounted for approximately 60% of illicit transactions. So there's still challenges. In recent months, nevertheless, one of the most significant developments has been the signing of the US's Genius Act, which requires stablecoins to be backed one-for-one by the US dollar or other low-risk assets. It has catalyzed the acceleration of stablecoin adoption and digital asset regulations globally, including in Asia. For instance, Hong Kong passed the Stablecoins Bill, which requires issuers to secure a license from the Hong Kong Monetary Authority. In Singapore, MAS had in 2023 issued stablecoin regulations that apply to single currency stablecoin packed to the Sing dollar or any G10 currency, requiring 100% reserve backing for licensed stablecoins. It has said it sees good potential in stablecoins, provided they are securely backed by high-quality reserves and well-regulated. Beyond blockchain, AI also has the potential to revolutionize the way finance functions. Agentic AI, which refers to AI systems that act as independent agents, autonomously making decisions and completing end-to-end tasks, could transform the way finance flows. For instance, with agentic payments, agents can score e-commerce sites, select a suitable product, make payment, and arrange for delivery, all with no or minimal human intervention. OpenAI has partnered with Stripe to launch an agentic commerce protocol, which allows users to complete purchases within ChatGPT, while Amazon's Buy For Me completes the end-to-end transaction process, from navigating third-party websites to processing payments autonomously within the Amazon app. Firms such as Google, PayPal, MasterCard, and Visa are also developing agentic shopping services. So that's the primer on the things we're talking about. So blockchain establishes trust. Many forms of digital currencies have got created. At least some of them, there is potential value and use that you can see which challenges or gets over some of the frictions in today's financial system. So moving now to Singapore. What have been the blockchain and tokenization initiatives in Singapore? In view of the profound changes shaping the global financial landscape, MAS has over the past few years embarked on various initiatives in collaboration with the industry to explore the potential for blockchain and tokenization to transform existing financial infrastructures and solutions. So Project Ubin. Project Ubin was implemented between 2016 and 2020 to explore the use of blockchain and distributed ledger technology for clearing and settlement of payments and securities. It saw the development of a multi-currency payments network prototype to settle payments in different currencies on the same network, enabling faster and cheaper cross-border transactions. It also led to the development of commercial solutions such as the party or platform I talked about before. Project Orchid. Beyond cross-border payments, Singapore has also engaged in pilots to boost domestic payments through Project Orchid, a multi-year project which aims to develop the technology infrastructure for a digital Singapore dollar. Though MAS has assessed that there is no immediate need for a retail CBDC in Singapore, it seeks to advance the requisite financial infrastructure in Singapore and explore potential use cases for programmable money in Singapore. These include DBS's Programmable Rewards Initiative, which allows DBS PayLah users to redeem digital vouchers directly within the app, OCBC's partnership with the LTA to pilot a blockchain-based conditional payment solution for construction projects, and a collaboration among Ant International, Grab, and StraightsX to allow tourists to use their home payment apps in Singapore. Bloom. Building on the foundations of Project Orchid, MES announced a new initiative called Bloom, which is borderless, liquid, open, online, multi-currency, in October this year to enhance settlement capabilities by financial institutions. Through Bloom, MES will collaborate with the industry to enable the responsible development of tokenized deposits and stablecoins for wholesale settlement. Finally, Project Guardian. In addition to payments, MAS has also piloted blockchain initiatives in capital markets. In 2022, it launched Project Guardian to enhance financial market liquidity and efficiency through asset tokenization. At the end of 2024, MAS had convened over 40 financial institutions, industry associations, and international policymakers across 7 jurisdictions to conduct industry trials. These include over 15 industry trials in 6 currencies across multiple financial products, including FX, funds, and fixed income. To support industry-wide deployment of tokenized assets, MAS has also implemented initiatives to enhance liquidity, develop public permissioned foundational infrastructure, implement standardized frameworks and protocols, and common settlement assets. For instance, it has proposed a technical standard on how new tokenized assets can be created. It is also partnering with the industry and global policymakers to promote network interoperability through the Global Layer 1 initiative. Now, in addition to the industry-wide initiative sponsored by MAS, banks have also launched their own tokenized financial solutions. For example, DBS has launched tokenized structured notes on the Ethereum public blockchain, while OCBC has launched the sale of bespoke tokenized bonds to corporate accredited investors, which are structured based on the client's desired tenor and yield. Asset managers such as Franklin Templeton, UBS, and Wellington Management have also launched tokenized money market funds in Singapore. Globally, tokenized money market funds have grown significantly. BlackRock's tokenized US Treasury Fund has reached over $2 billion in market value, while Franklin Templeton's tokenized government money market fund, Benji, has gained over $500 million in assets. Moreover, as crypto companies seek to access regulated banking services and banks seek to offer a wider product range, these institutions have collaborated to offer new tokenized solutions to customers. In Singapore, for example, StraightsX and Paxos Digital issue Sing dollar and US dollar stablecoins backed by reserves held at DBS and Standard Chartered. So, shaping the future, what are the potential paths for Singapore? I guess the point I'm making is that we've done a lot of pilots, we've built a lot of infrastructure, we have built some muscles in the space. As you've seen, Singapore has embarked on several blockchain and tokenization pilots. However, these remain on an experimental basis. Moreover, MAS has been conservative in some areas, such as in its approach to allowing retail access to cryptocurrencies. For instance, while DBS was one of the first banks globally to create a digital exchange to enable the trading of digital assets, it was not allowed to expand its access to retail customers. This has been a deliberate policy choice. While MAS recognizes the potential of blockchain and tokenization to transform the current financial system, it has been cautious to ensure consumer protection. Yet with consumer adoption of cryptocurrency on the rise, today 26% of Singapore residents actually own digital assets at the end of 2024. This has pushed cryptocurrency to outside the regulated sector. Today, regulators in other jurisdictions have embraced digital assets, including the Genius Act I talked of in the US, pursuant to which banks such as JP Morgan have allowed their customers to link their bank accounts to Coinbase cryptocurrency wallets. I believe that we stand at the cusp of a pivotal opportunity for a massive transformation of the way finance works, and there is thus tremendous potential to embrace a completely new world order. Just as Singapore took bold and decisive steps to embark on a wave of financial sector liberalization in the 2000s in response to changes in the global environment, we now have the opportunity to shape the future of finance. As we've done in the past, we can leverage our strengths, our nimbleness, strong public-private partnerships, our ability to think big and be bold to transform the way finance flows, whether in banking, capital markets, asset management, etc. This would require a collective will to architect a completely new infrastructure and bring all players, incumbent financial institutions, startups, non-FIs, as well as the public sector together to co-create and shape a new financial order. This is not a mere pipe dream. Over the past decade, we've achieved this in the payment space. MAS and the industry came together to develop infrastructures such as Fast and Pay Now, which has gained widespread adoption among institutions and consumers. And frankly, other countries such as India have likewise developed public digital infrastructure such as the Aadhaar system, which has been rolled out nationwide and allowed the country to achieve massive digital penetration. In the same vein, there is potential for Singapore to usher in a world anchored by AI and tokenization and underpinned by a financial architecture that is more efficient, flexible, and secure. Now, granted, there will be risks. There could be a 50% chance that the world would completely embrace this, but also a 50% chance that it won't. But given the massive changes afoot, we need to make a leap of faith to continue thriving as a financial center. Let me illustrate some examples of what this new world could look like and how blockchain could transform the nature of value transfer in both financial and non-financial assets across areas such as payments, capital markets, and real estate. So, payments, digital Sing dollar. In my previous lecture, I spoke of how the industry came together to build public infrastructures such as Fast, Pay Now, as well as SGQR, which has enabled greater payment efficiency and interoperability. Through Project Orchid, MAS has also piloted purpose-bound money, which allows programmable payments for specific use cases to smart contracts. Moreover, the three Singapore banks, DBS, OCBC, and UOB, have successfully conducted interbank overnight lending transactions using the first live trial issuance of Sing dollar wholesale CBDCs for settlement. But there is scope to be bolder in imagining the future of payments, such as by launching a digital Singapore dollar. A digital blockchain-based Singapore dollar would serve three purposes. First, it could potentially serve as a common form factor and payment type. As some have observed, while there has been greater alignment of payment systems, there remains a range of form factors, be they cards or QR codes or e-wallets, etc., which depend on multiple payment rails that may not be fully interoperable with each other. For instance, consumers currently may not be able to pay using their preferred payment method if a merchant does not offer to accept it. A common digital Sing dollar, such as a Sing dollar or a retail CBDC, would thus serve as a common foundation and single form factor that flows freely between any wallet or card. For consumers and businesses, this will reduce confusion from having multiple form factors and enable a more seamless and unified customer journey. Moreover, the programmability function that could be offered by digital Sing dollar has the potential to further unlock new use cases. Second, it could provide a buffer against potential outflows to US dollar stablecoins. We are now seeing a shifting global payments landscape. On the one hand, uncertainties surrounding US policy as well as structural changes in the global economy have put pressure on the role of the US dollar as a safe haven currency. And at the end of last year, the dollar accounted for 60% of global foreign exchange reserves, down from 65% a year earlier. Moreover, the emergence of both private and public digital currencies, as well as the rise of the alternative global currencies such as the RMB and the euro, could reduce the dollar's dominance. On the other hand, as I pointed out a little while ago, the rapid growth of US dollar stablecoins and the dominance of the US dollar in the stablecoin market could further entrench the US dollar's role as a reserve currency and lead to a greater reliance on the US dollar, especially as these tend to be used as alternative to US banknotes in some emerging markets. Regardless of the direction of travel, launching a digital Sing dollar would be a defensive move against the potential for Sing dollar deposits outflows to US dollar stablecoins. It will also position us to be able to participate meaningfully in a world with diverse digital currencies. Third, the launch of a digital Sing dollar would further entrench Singapore's reputation as a leading global financial center at the forefront of future technologies. It will send a strong signal of our position as being ahead of the game and our national intent to embrace a new tokenized world. Next, capital markets. Beyond payments infrastructure, there are also opportunities to revolutionize Singapore's capital markets, especially its equity markets. While the recent measures to revitalize the stock market are a step in the right direction, there is potential to fundamentally rethink and re-architect a brand new capital markets infrastructure. Currently, capital markets face inefficiencies, especially post-trade, such as long settlement times, high intermediation costs, and error-prone manual processes. Tokenization offers the possibility of greater efficiency and automation across the entire value chain, including issuance, trading, settlement, and asset servicing. For instance, blockchain-based issuance of financial instruments can reduce the number of intermediaries and manual processes involved, thus lowering cost. According to Ripple and BCG, tokenizing an investment-grade bond can reduce operating costs by 40 to 60% compared to traditional issuance through workflow automation and paperwork reduction. Settlement of such tokenized bonds could occur nearly instantly compared to the current several days, thus improving capital efficiency and reducing counterparty risk and chances of reconciliation breaks. Moreover, current compliance processes remain manual, burdensome, and are subject to tampering. Programmability through smart contracts enables regulators and issuers to hardwire compliance mechanisms into financial instruments, such as eligibility restrictions, automatic disclosure triggers, or circuit breakers to mitigate volatility. DLT-based disclosure ledgers could reduce issuer costs and supervisory burdens, with smart contracts automatically notifying regulators of late filings or discrepancies between reported and actual performance. This allows regulators to shift from periodic manual oversight to real-time monitoring. By embedding disclosure obligations into distributed ledgers, issuers could also provide investors with transparent and real-time information. A prospectus could be issued as a tokenized document, with smart contracts automatically updating disclosures when predefined events occur, such as changes in credit ratings or significant shareholder shifts. In Singapore, industry players have already implemented foundational blockchain infrastructure. SGX Group and Temasek have established a joint venture called MarketNode to develop digital asset infrastructure based on smart contracts and tokenization. The platform, which is Asia Pacific's first exchange-led digital asset venture, aims to streamline capital markets processes. For instance, it has rolled out an end-to-end fund order and processing solution for retail and institutional funds in Singapore. There is thus potential for Singapore to be bolder in shoehorning industry players to adopt a new blockchain and token-based infrastructure to transform capital markets. In addition to financial assets, tokenization can also unlock value in real-world assets, such as real estate. Today, the real estate market is illiquid, inefficient, and paper-based. Property searches and closing of transactions tends to take a long time and involves several intermediaries such as real estate firms, lawyers, and banks. Tokenization of real estate presents opportunities to streamline and unlock efficiencies in this process. Recording every transaction on the blockchain ledger allows easier verification of ownership and mitigates risk of tampering, while smart contracts can automate the mortgage process, improving speed and reducing errors. Beyond process improvements, the tokenization of real estate could also potentially create new markets, such as a mortgage securitization market, where mortgage debt is pooled and fractionalized into tradable and investable mortgage securities. Deloitte forecasts that $4 trillion global real estate will be tokenized by 2035, up from less than $0.3 trillion last year. In Europe, for instance, mortgage fintech firm M-Cube has tokenized 1.3 billion pounds of mortgage debt, while Figure Technologies in the US has packaged home equity line of credit into publicly rated blockchain-based asset-backed securities. BCG estimates an additional 500 million to $1 billion in potential new capital via fractional ownership and broader investor access for real estate fund with roughly 5 billion in AUM. Now, realizing these benefits will not only require changes in financial infrastructure, but also changes in legal regulations on title deeds, conveyancing, property titles, etc. It will also require the convergence of various stakeholders across the ecosystem, including real estate firms, law offices, banks, and so on, working together to reshape existing financial and legal infrastructure. Now, what would it take to architect a new financial order? The examples I've illustrated across payments, capital markets, and mortgages are but a fraction of the possibilities that blockchain and tokenization offer. As a country, we now face two choices. On the one hand, we have come far and achieved much. With the stakes higher than before, some may argue that we should proceed to the next phase with care and caution. On the other hand, we are now in a position of strength, armed with an abundance of resources, financial, technological, and human, to commit to architecting a new financial infrastructure and transforming the way finance flows. Smart contracts and tokenized forms of exchange, including new forms of currency, along with Gen AI and agentic AI, could pave the way for a more efficient, cost-effective, and innovative financial system. Now, what would it take to achieve this? We will need to build interoperable technological infrastructure at scale, while industry players will have to reimagine their current processes and change the way they work. We would not be starting from scratch. Under Project Guardian, MAS has been working with a consortium of global policymakers and major FIs to develop standards for tokenization, including publishing frameworks for funds, bonds, and FX as global public goods. Industry players have also embarked on several pilot tokenization use cases, as I pointed out. To achieve widespread adoption at scale, however, MAS has identified factors that need to be in place. These include, obviously, meaningful use cases by industry players that are of value for clients, standardization of asset-backed tokens and interoperability of networks, a deep pool of safe and reliable settlement assets, and institutional-grade networks. These would provide unified, interoperable, and secure infrastructure upon which a thriving ecosystem of various digital public and private currencies, as well as tokenized assets, can be built. Beyond technological requirements, legal and regulatory frameworks will also need to evolve. While regulations around traditional finance have been in place for decades, governance of DLT-based finance will require different sets of rules. For instance, regulators will need to provide clarity on regulatory treatment of various types of digital assets, consumer protection requirements, digital property rights, and so on. Global cooperation will also be essential in some cases to standardize regulatory frameworks as well as pilot cross-border use. This will enable the multitude of players in the industry, including central banks, commercial banks, digital upstarts, and so on, to innovate new forms of currency and digital assets while ensuring trust, monetary stability, strong risk management, and adequate consumer protection. MBS Managing Director Chia Dojuan has noted, this tokenized future cannot be built by a single party. It will require collaboration between private and public sector within and across jurisdictions. Now, to this observation, I offer two supplementary thoughts. One, as I've shown, there are enough opportunities for Singapore to proceed without waiting for all the global alignment that will inevitably be long in coming. In many ways, moving now will give us distinct first-mover advantage. Second, collaboration will not be achieved without the public sector leaning in actively to drive the agenda. This is our competitive advantage. We can bring the whole of nation together if the public sector leads the way. If there is any country that can pave the way for such a future, it is Singapore. With its forward-looking regulator, deep technological foundations, close public-private partnerships, and strong spirit of innovation and enterprise, Singapore is well placed to architect a new financial order. Just as Great Britain served as the launchpad for the Industrial Revolution back in 1750, which transformed the country from an agrarian to an industrial society, so too can Singapore be the launchpad for a new financial architecture. In conclusion, over the course of my 3 lectures, I have discussed how Singapore has thrived as a global financial center over the decades by forging ahead with a bold and pioneering spirit, close partnership between industry and regulators, foresight in anticipating structural shifts, and nimbleness to adapt to new circumstances. From the creation of the two-tiered Asian dollar market to the development of world-leading and world-first innovations such as SGQR, Singapore has successfully struck a delicate and judicious balance between innovation, trust, and stability, which has allowed Singapore to constantly punch above its weight. How can we continue to do so, and where do we go from here? The fundamentals and purpose of finance and banking have remained unchanged over the course of history. This includes helping individuals save for the future, buy a home, or grow their wealth, as well as help companies grow. Going forward, however, what will evolve is the form of money, the infrastructure on which finance flows, and the mix of players in the landscape. In this new world, the AI and blockchain revolution has the potential to transform finance as we know it today. It presents opportunities to reshape existing infrastructure and transact with new forms of money. The future of finance is thus up for grabs. It belongs to any and all who embrace technology, stay nimble and agile, and have the vision and boldness to reimagine and build a new financial world order. The future is ours for the taking. Singapore is small enough to be nimble, but big enough to matter. It is one of the most stable countries in the world, yet one of the most innovative. It is highly pragmatic, yet bold enough to dare to dream and build a new future. While the world around us will continue to evolve, with new types of money, players, and technology entering the fray, the underpinnings of our success remain constant. Our adaptability, our spirit of innovation, our deep societal trust, which has fostered close collaboration between the public and private sectors. These themes have echoed across the Singapore story, and it is my hope and belief that they will continue to resonate as we write the next chapter of the future of finance. Thank you for your attention.
Thank you, Mr. Gupta. For those watching the lectures online, please submit your questions through the respective chat boxes. For our audience members here, please step up to the mic to ask your questions. May I now invite Mr. Caesar Sengupta, CEO and co-founder of Arta Finance, an AI wealth platform, to start the Q&A session. Mr. Gupta, please. Mr. Sengupta, please.
Piyush, first of all, thank you so much for these 3 lectures. I enjoyed the first 2 lectures, but this was my favorite. I think this sort of brought your pioneering spirit that you've had at DBS and sort of helped articulate this wonderful and ambitious, bold future for Singapore as a leader in finance.
You would say that because Caesar was one of the founders of Google Pay. So he's speaking to his own book.
But in a way, that is the future. So thank you so much for articulating that so well. So I'll start off with a few questions, but as people have questions, please do line up at the 2 mics. My request is, I'm sure, as I've seen in the last 2 lectures, there were lots of questions, so please keep your questions brief. And if you can ask a question rather than just make a comment, that I think helps Piyush answer them. So I'll kick off with a few, but then as soon as I see people lining up, I'll want to try to open up to the audience. So Piyush, let's try to keep this interesting for everyone, right? And so I'll try to be provocative a little bit. So, you laid out a really bold vision for us taking a leadership position in how we frame digital infrastructure for finance in the world. But MAS is saying there's no immediate need for a retail CBDC. We've heard similar statements about other stuff. At what point or what sort of metrics do you think it'll become absolutely clear that there's no choice but to embrace the future this way?
See, I don't think you will get to any kind of tipping point when you say, oh, we have to do this. Because I don't think fiat currencies are going to die anytime soon. So there's a lot of inertia about money. Also, by regulation and law, people won't ever get to a stage where saying you can't use a physical Sing dollar or it's not acceptable as tender, legal tender. So I don't think you'll ever get a gun to your head saying you must do it. Also, and by the way, I've changed my views on this. For the longest time, I was also in the same camp as MAS, that in Singapore, you really don't need a retail CBDC. Why? The real value a retail CBDC brings is instant payment, right? So you can use a single form and do instant payment. In Singapore, because of Pay Now, you can type anybody's phone number, instantly the money goes to their phone account anyway. We pay now, etc. With QR code, just scan a QR code, money gets transferred immediately. So this whole value of immediacy of transfer, real-time, online, immediate transfer, we've already by and large sorted out. So since you've already sorted it out, that's MAS's point. So, what's the immediate need of a retail CBD since we've already solved the problem? I've changed my view on this for the 3 reasons I articulated before. That one, even though we've done this, there's an article in the States Times or Business Times a few weeks ago, which I thought captured the point well. We created a common SGQR, saying everybody can use a single QR code. But despite that, we've not been able to get everybody on a single QR code and interoperability. And so, depending on what QR code you have, some people can use it, some people can't use it. So I think there is some value in getting convenience of having just a single form of payment, which is the digital Sing dollar, which is accepted. So you do get some convenience there. The second, as I said, I'm increasingly worried that if stable coins take off and US dollar stable coins take off, then you run the risk of a large part of Sing dollar deposits moving out into a US dollar base. And we've tried never to internationalize the Sing dollar. But through this route, you might wind up with more and more of your deposit circulation moving to US dollar. Having a digital Sing dollar guards against that. But the third, I think it's quite important, is it's a statement of intent. If you want to showcase yourself as a nation at the cutting edge which is leading the charge on tokenization and digitization, this is a small price to pay, even if you think the value add is marginal, the branding value and the statement it makes is actually quite considerable. So now, then you got to worry that there are some tail risks of going digital Sing dollar, right? And one tail risk is this: if you have, especially if the central bank issues it directly to the citizens, you run the risk of a run. If anybody suddenly feels very worried about the banking system, they'll all switch to the central bank account, and the central bank then has to start giving loans. No central bank wants to give loans, right? But that's an easy fix. You don't issue it directly, you issue it through the banking system. That's where you guard against that, so you have an intermediate Sing dollar. So I think there are ways to do it. There is no immediacy, but my argument is that if you wait till it becomes incumbent and critical, you've lost the first mover advantage. The time to do it is when there is no real need to do it, but you can make a statement by doing it. And that's for, the argument is we might want to think about doing it ahead of time as opposed to waiting for some eventuality.
Yeah. And maybe just building on that and asking a question on that, is there a strategic reason also at a global level? Because right now, US dollar seems to be primarily the stable coin backing. And there are many countries around the world that are looking for an alternative to the US dollar. So could Singapore actually have a standing there?
It's hard, I thought it's very hard. We're too small as a country, and therefore, even though we have a lot of reserves, but nevertheless, in the big scheme of things, for people to start thinking of the Sing dollar, issued retail currencies as global currencies, not very likely, except maybe we could start using it in the region. Maybe we could start using it in specific bilateral context. You look at what the Chinese have done with their, RMB, internationalizing the RMB. It's slow, but if you look at the SWIFT data, the RMB usage has gone up from, 3-4% to 4-5% in the last few years. And they've done it by being targeted. They targeted the oil trade, and they told all the Middle Eastern, you must trade in renminbi. And so they found all options for using the renminbi offshore in very targeted ways. And so, there is that opportunity for the Sing dollar as well.
Absolutely. Thank you. Do you want to go ahead with your question?
Thank you.
It'd be great if you can introduce yourself too.
Sure. Thank you so much for your profound insight and wisdom, Mr. Gupta. My name is Patrick. I have 2 quick questions. Do you see any sign of an AI bubble? Right. And second question is, what's your economic outlook and the key megatrend you foresee for 2026? Thank you.
All right. Not the subject of my talk, but I will do it very quickly. So, do I see an AI bubble? It depends on whether you're asking me, are the stocks overvalued or is the underlying technology overestimated? So, if you ask me the underlying technology, I don't think the bubble at all. I think it's a complete game changer. The ability of AI already to make predictions is outstanding. And with generative AI, the ability of AI to do what we do, which is to read, to synthesize, to produce output, and to perform actions through agentic, is remarkable. So I don't think that's a bubble at all. I do think it's going to have very consequential impact. And by the way, for those of you who think it's only a white-collar phenomena, that's not true at all. Increasingly, robotics linked with this AI is changing factory flows, production systems, home assistance, everything. So I think it's very consequential. In terms of the market and market movements, there'll be individual stocks which are overpriced. Can Palantir justify 260 times forward earnings? I don't know. However, I will tell you this, that when I talk to young startups today, they tell me that if they want to go and get AI capacity from any of the big players, you can't get it on the tap. You still take 3 to 6 months to get capacity. And that tells me the capacity is still short. And that's something to think about. Economic outlook, kind of hard to say. I think the Fed will start continue cutting. There'll be a rate cut, hopefully. Not hopefully, I think there will be a rate cut. I think the impact of the tariffs has been less than people thought. So I do think that as we go into next year, you might continue to see a world which is not different from this year. Reasonable rates of growth, relatively low inflation in the short term. Longer term, it's much harder to call.
I think we came here to hear about the future of finance, but you also heard about markets. Thank you. Mr. Hiro.
Thank you. My name is Hiro. I work in developing businesses using technology. Thank you very much for a very comprehensive outlook on the use of technology in finance. My question is related to the high energy cost of blockchain. I think tokenization for real estate is quite good because the frequency and the number of transactions is not that high. But if it goes to, let's say, Bitcoin or let's say cryptocurrency, does the high energy cost of blockchain make sense in terms of the high frequency in these transactions? Thank you.
That's a good question. I guess I don't have all the right answer, but two observations worth thinking about. One is, even after all of the energy costs and data centers and so on, if you look at the total utilization of energy targeted at data center and compute, it is less than 1% of global energy demand. So it is huge, it's material, but it's not in the scale of transport, aviation, and so on. And increasingly, more and more data centers are adopting greener forms of energy. So hopefully that will shift. People are also adopting a lower cost of consensus establishment, right? And so new forms of tokens which employ lower forms. So it's my hope that you will be able to get greater efficiency. What people haven't factored, which I haven't seen any work on this, is what happens if you can actually take out 30% of work. If you can reduce 30% of work, there will be a corresponding reduction in the energy requirement, and you're then trading off more energy in compute versus less energy in 30% less work. So on balance, is it worthwhile or not? I'm not sure anybody's done the math on that yet.
Thank you. The lady up there.
My name is Helena Chu. Thank you for your presentation, Piyush. In your presentation, you mentioned that trust has been eroded. Indeed, trust has indeed been eroded. Your motivation seems to be to make a headline, a statement, instead of believing in blockchain technology, which I am an advocate of blockchain, and I am a strong believer of blockchain. I study in MIT, blockchain as well as cryptocurrency. Okay, under your leadership, we experienced bank crisis we have never ever seen before in Singapore. Under your leadership, we were locked out of access to our accounts, and security was compromised with record high money laundering and scams. So you headline your speech for Singapore to punch above her weight. Perhaps it is a return to the belt of truth and integrity in this Jubilee year of hope on this birthday of a girl who storms out serpents. So your thoughts, please, for the future of finance. Thank you.
I'm not sure I followed the argument completely. First of all, I said trust has been eroded in some situations, especially in countries and governments where there's hyperinflation. So I certainly don't espouse to the fact, to the case, any case, if that's what you're making, that trust has been eroded in the Singapore banking system, because all of the surveys of public trust in Singapore hold the trust in banking system extraordinarily high. The Edelman survey for banking sector trust in Singapore rated the banking system at 74%, the highest of any institution. So I don't think trust in the Singapore banking system has been eroded. However, I think the underlying case that we have to continue to work on making sure that we stay trusted is really true. And that is why I talk about this balance between trust, innovation, and stability. It's not an easy task for a regulator. Right? You've got to continue to innovate, but at the same time, you have to be conscious of the fact that in other industries, you can focus on creating a minimum viable proposition. If something goes wrong, you'll come back and fix it. You can't do that in finance. And so it's not an easy thing to continue to be cutting edge at the same time to retain trust. And so you have to consciously work very hard at it.
Piyush, in the last lecture, you talked a lot about this tension, right? And you brought up a very interesting idea where you just mentioned it, and I would love for you to go a little bit deeper into it, which is this whole idea of a digital scam insurance as a national system. And you talked about how with evolving technology and people not adapting fast enough, I mean, this is becoming a higher priority. If you don't mind, I'd love for you to share that and maybe expound on it a little bit.
So my thought was this, that today, as a practitioner, when I was CEO at DBS, I went around trying to see if I could find insurance and insurers who would insure against cybercrime and scams. And it's not easy to do because the insurance industry itself doesn't know how to underwrite that risk. They don't know what is the potential size of the damage, and if something goes wrong, how big it could be. So there are all kinds of caveats, risk protection, what you can do or not, and therefore it's very hard for you in turn to offer something to the consumer. So it just seems to be that we are in a transition phase where people haven't got their minds around how do you dimension the risk of this new ecosystem and the change that is involved. But then I think this is not the only time when you say, hey, it's very hard to think about this risk on a pure commercial basis. The methodologies or the thinking around it is not just well developed. And therefore, that's the role of a state. When you come in as a state, you're given a mandate to try and build what I think of as public infrastructure. When you build public infrastructure, oftentimes that public infrastructure is effectively borne by everybody. When the taxpayer bears it, that means the whole country bears it. The whole country is bearing the cost of a public infrastructure because we're trying to take the country forward in a particular direction. So when we build Changi 5, or when we build a whole infrastructure around something, right, effectively the taxpayer is bearing it. We're all collectively saying, we don't know if this will work in the future or not, but it's worth it as a country to do it. So I now think of this transition to a digital economy in much the same way. That if we believe as a country that this is worth investing in, because this will help protect our future and shape the way forward, then maybe we should all collectively as taxpayers and citizens bear the brunt of this transition. And one way to do that is to actually create an insurance mechanism which is state-sponsored and state-funded. And that's the germ of the idea.
Oh, it's very, very interesting.
Thank you very much. My name is Brent Matthew. I am from the University of Asia and the Pacific in Manila. Singapore has been a model for many countries in the region. You mentioned the importance of clear regulation while also underscoring the need for innovation. Whether it's legislation or policy directives from private and public sectors, how do we ensure that we close up loopholes to protect our system from criminal activity while ensuring that we do not create an environment where innovation is stifled?
I just referred to that. This is another one of those get the balance right. But so I've used this analogy before, right? There is no country in the world where you have zero crime, right? If you had a zero crime environment anyway, you wouldn't need a police force, you wouldn't need a Department of Justice, you wouldn't need courts and so on, right? The reason you have all that is human nature is that there will be some crime. So recognizing that crime is there, you create and establish a police department, and you have judges, and you have a whole infrastructure to go and figure out and try and catch criminals. I think we need to understand that and take the same parallel to financial crime. The notion that we will be able to lock our doors in such a way that you will never have financial crime, there will never be financial criminals, I think it's really very simplistic, cannot be, right? So the minute you open a door, some people will scam. Somebody will want to forge a signature, somebody will come to the ATM and try and scam and take money out. Even in the old world, somebody will come and fool somebody to take money away. In the digital world, it gets compounded because the scale gets magnified. If you can do something, you can do it at large scale. So those are challenges. But the idea that you can actually have a zero crime world and lock everything out, I think is too simplistic. I don't think it's possible to achieve. If that is the case, then you need to figure on two things. One is, how do you put in place a system that minimizes this?
So what are your processes, what are your regulations, your controls to make sure people go through due care? But if due care is good, right? But if you try to take it to the level where you want to lock everything, then you will definitely stifle innovation. So I think the burden of due care is appropriate, but understanding how much is due and responsible care is important. But then you need to match it with two things. One is you need to match it, if you can't control at origination, how do you control after the fact? You need to build in and leverage technology. Use AI, use anomaly detection tools, use behavior tools, saying if somebody does get in through the doors, through an unlocked window, how quickly can you catch that person? And how quickly can you quarantine that person? So you need to invest a lot in technology to be able to do that smartly. The other thing is going back to your question, Caesar, that let's assume you've done that, you've been able to quarantine, you found somebody, but people still get hurt along the way. How do you offer consumer protection to make those people good and whole? So I think that's what we need to do. Not believe that you will lock all the doors and windows all the time. Because if you lock all the doors and windows all the time, you will stifle innovation. Put in good doors, put in good windows, make sure you have good locks, but recognize that somebody will get in. And when they get in, how quickly can you catch them? And how quickly do you create a compensation mechanism? I think that's a more balanced way of approaching this.
Makes a lot of sense. So,
hello, Piyush. My name is Mark. I run a deep tech investment and venture building vehicle, Alonic. You spoke a lot about blockchain and tokenization, and you're clearly bullish on the prospects of these technologies in terms of transforming finance in the future. My question is, are there a few other technological areas or maybe even shape solutions that you foresee that they could change finance in midterm, 5-7 years from now? If yes, what could they be?
I think, obviously, I didn't delve deep into AI and agentic. In the short term, if I had to bet on what's really already changing the nature of finance, it is AI and agentic. So let me go back to my DBS days as an example. At DBS, we started dealing with predictive AI models and making behavior predictions almost a decade ago. And in the last 4-5 years, DBS started measuring the delta from predictive models. And I mentioned in a previous lecture, at the time of my retirement, DBS was using 1,500 plus models across 350 different use cases. And the economic value of that this year is over $1 billion. That's a game changer, 5% of the revenue. And that came from better marketing, better risk management, lower costs across the whole spectrum. And in that, I think they'd only scratched the surface. So the potential for massive change and value creation, even through the old predictive AI models, is huge. Very few people are still leveraging that adequately. Obviously, Facebook, Netflix, Alibaba have been doing that at scale, but in the financial services industry, it's still very nascent. In the last 2 years after Gen AI, like everybody, DBS started looking at saying, how do you drive and leverage Gen AI to really rethink stuff, and including agentic. And again, at the time I retired, it actually thought of and had a whole range of programs, which my ex-colleagues tell me they're still working on quite assiduously, which changed the nature of back office operations fundamentally, completely. And therefore, it's not just a question of using internal GPT or a knowledge base. All of those are helpful. But structurally, the nature of work is changing. We used to hire tons of people to pass accounting entries, debit this, credit that. The people would reconcile records. People would send emails and follow-ups. Now, Gen AI does all of that. So you have to actually reimagine your end-to-end process. And if you do that, without doubt, there is 30-40% productivity. But you can also start creating completely new business models on the back of leveraging agentic AI. So frankly, if I had to bet, I'd say agentic AI is more imminent and more likely to start showing financial economics and value today, much more so than blockchain and tokenization, if you want an immediate response.
Actually, since we're on the topic of agentic, let me ask a question that came up while you were talking. You talked about how agentic will likely automate the whole consumer journey end to end. If that happens, what role does a bank play? Does it become invisible? Does it defer everything over to the platforms like OpenAI and Google?
Yeah. So, I struggled with this question 10 years ago, even when we started digitizing everything. Because even in those days, the whole, even pre-AI, right, the idea was embedded finance. And so the idea of embedded finance was people should not have to come to DBS to deal. We should be hidden and invisible behind what customers really want to do with their life. Customer wants to buy a house, they don't need a mortgage. Customer wants to buy the car, they don't need a car loan. They want to go pay for a meal, they don't need the credit card. And so very early I had this vision of making DBS invisible and hiding them behind what the customer really wanted. And of course the big question was this, that if you're really invisible, you have no brand relevance. The customer doesn't know it's you. You're hidden behind something. And if that is the case, how do you build any brand equity? So the parallel I used to use at that time was Intel Inside. So Intel was inside every computer. Nobody could see the chip. So they had to put stickers on the computer saying Intel Inside to remind you that Intel was inside. Now, why did that matter? It's important. It mattered because they had simultaneously built this brand image of trust, reliability, consistency. So people knew if the sticker said Intel Inside, it was likely to be a better computer than a computer which did not have Intel inside. So my first response to you is, irrespective of what you use, if you can build this thing of efficiency and trust, the product you have hidden in there is superior to other people's product, trust will still matter. So when you're doing Arta, you're white labeling Arta through so many banks as a white label. I can tell you if the word in the market is that Arta's AI tools do a better job of finding and selecting and so on, right? People will still want to say, hey, do you have Arta inside or not? Now, eventually, you could get to a world where everybody is self-sovereign. Each of us has our own agents, and our own agents are talking to other people's agents, and the agents are completely oblivious to the brand. They're only looking at functionality. So if you do get to that kind of world, then I have to rethink my view. But in my own view today, we're still, the branding matters. And brand is not just for trust. Sometimes it matters for prestige, right? So you brand, you say this is a superior product because it has X, Y, Z inside. So I do think there is some leverage around that. The second, in the more immediate short term, I found that especially in matters of money, people like hand-holding, right? And so people need an orchestration layer. No matter how good your digital is, right? People will still like to call the banker. And even if there are all kinds of agents anonymously bringing things and showing you, people still need to say, okay, can I go to one page or one place where I know that they've done this work for me and aggregated and brought it together. I don't think that's going to disappear in the short term. And again, in a strange way, ironic way, the best way I think about it is the creation of investment banking. So you go back to 50, 60, 70 years ago, right? The whole idea was, what do banks do? I take money from you, the depositor, and I give it to you, the borrower. So I'm just sitting in the middle, and I pay you 3%, I charge you 6%, and so I make a good profit, right? So people said, why should we pay the banks 3% to take from one and give to the other? We'll create a new industry where you can go directly there and borrow the money. That's capital markets, right? Yeah. So you issue a debt paper, you issue equity paper, you go directly. So in theory, that was supposed to disintermediate the banks. In practice, what happened, you created another industry, investment banking, which is as big or bigger than commercial banking. Why did that industry get created? Because people needed hand-holding and orchestration. The issuer was not clear about how do I go straight to the market, and the investor was unclear about what is it that I'm getting into. So you just morphed the role of the bank to being an orchestrator of a different form. So I do think that in the foreseeable future, you will still see that there will be a role for an orchestrator and orchestration layer, even in this kind of world.
Yeah. For what it's worth, I completely agree with you. I think the brand and the trust really helps facilitate commerce in this space. The lady up there, if you don't mind, she's been standing for a long time. Thank you.
Hi, thank you. This is Rithvika from Bloomberg. Hi, Piyush. I have two questions. I'll make it really quick. First is, DBS is one of the few local banks who've been transparent about what who've been transparent about what AI will do to its workforce. What's the one thing that Singapore's banks are getting wrong about AI adoption right now? And congratulations on your appointment as chairman of Temasek's India unit. Where do you see the biggest untapped opportunity there?
Well, on the first one, I think it's not just Singapore. I can't speak for the entire banking system in Singapore, but I will tell you the earlier question. I think, first of all, a lot of people still haven't got their minds around how much of a game changer this truly is, and what is the economic value that can get created by going all in. So I've always had this There's some cases you got to do IRR and figure out should I invest or not. AI is not one of those. You need to go all in, which means that you've got to take a genuine leap of faith that this is going to have payoffs. And if you're not willing to do that, you will not make the investments that are needed. The most significant investment is in data. And so in DBS, we started the data journey in 2012, but 2017 onwards, so it's almost 8 years, really doubled down on data, created data factories, data machines, metadata, data lakes, and so on. And it's still only a fraction of the job. So to me, if anyone in the banking system really wants to go all in, and frankly, this is something for us as a country as well, we just really have to get the data equation right. On the India is a fantastic opportunity. It's continues to grow at plus minus 7% real, circa 10-12% nominal GDP growth. It's the fastest growing part of the ecosystem, and certainly not only in our part of the world, anywhere. And it's got a large domestic economy, so it gives you opportunities in 3 or 4 broad places. Domestic consumer demand, which is booming, and you can play that through the financial institutions, you can play that through FMCG, you can play that through young startups dealing with that space. It's got a large healthcare and life economy, so there's a huge opportunity around that. I do think in select sectors, it does have a manufacturing possibility, though it's very nascent. So both for the domestic market and for the export sector, it's nascent, but there are opportunities. But there are just so many immense opportunities in the country. It's already a large business for Temasek. It's a significant portfolio. As you go forward, I just think that the opportunity to continue to grow in that market is going to be considerable.
Do you have a follow-on?
Yeah, I mean, do you have a goal as to, like a number figure you can give us as to how much you want it to grow?
I just joined as chairman a week ago. don't even know what is there, forget a goal.
Okay, thank
you. I am headed to India right after this meeting, so maybe I'll start forming a view in a few days.
Great, thank you.
Okay. The lady there.
Thank you so much for sharing your aspirations as well as insights today. My question is, what would speed up the convergence of the familiar Web 2 with the benefits of Web 3? Like, I think we're talking a lot about both the challenges as well as the future. But what would help speed that up in your mind?
So there's a point I made. I think if you look for opportunities, like the capital markets domestic, or the mortgage and real estate market in the country, or for retail CBDCs, you've got to find enough opportunities in the domain where you can lean in. You're not that reliant on global alignment around that. And you can focus on process change. You can do that. And to do all that, you need to have somebody who catalyzes the change. In this case, and Singapore's got a history of doing that. You look at the formation of Jurong, right, or any of these big things. So we got the infrastructure right, but the government leaned into saying, hey, we're going to get this done, and then we coalesced and brought everybody together. So in an ironic way, while I think it's really important for private sector and individual enterprises and players to play, it always helps to have an organizing, coalescing force. So to speed this thing up, I think to find the right use cases which are not overly reliant on a global consensus around the use case. And second, have the public sector lean in to drive and shoehorn the system.
Thank you, Piyush. Let's take a last question so that Piyush can get on his flight to India.
One, or am I just trying to rush you? Piyush, this is Sandeep. I run a fintech in an emerging market in the Philippines, so I'll ask you a question from that context. If you look at your 2 slides, I think one slide laid the evolution of the medium of exchange and the rails on which the medium was exchanged. And in the last few years, or I would say couple 50 years, the medium of exchange, which is currency, has remained the change. The rails have what has evolved, right? Credit cards, QR codes, and so on and so forth. But as you see your own slide, it sort of evolves both simultaneously, which is the currency medium of exchange changes and the rails change. And that in itself is a challenge because you're changing on, and I come from a data background, so XY scale, you're changing both X and Y simultaneously. From a consumer perspective, that's a big change, right? Because now the consumer, especially the consumers who are not in this room, who are outside, who are regular consumers, have to adapt both. Any perspective in sort of your research learning, how do you bring the consumers that are not in this room, who may quickly understand moving both these dimensions simultaneously into the play? Otherwise, you'll have that challenge, less so maybe in Singapore, but as you get into Philippines, Vietnam, India even, you'll have this huge diversion of a consumer who changes the XY rail and a consumer who's completely left behind.
So Sandeep, one thing I think you need to do is, in some of the cases, create a parallel infrastructure as opposed to an evolutionary infrastructure. Because you try to evolve, it's complicated, you need interoperability, and you need to take everybody. But if you were to create a parallel set of rails and infrastructure catered to the new thing, then you don't dislocate what exists, but create an alternative. And if it's a compelling alternative, you start getting people to start adopting parallel infrastructure. I think that's one way to be able to achieve it. I do think that you'll find a lot of people will take to that parallel infrastructure quicker than we anticipate. Already, you take, it's not fashionable now, but a few years ago, right? So, what do you call them? The tokens, loyalty tokens and so on. All the young people across this thing were looking at all of these loyalty tokens and, memes, etc. So Gen Z and young people adopt to these parallel infrastructures very quickly. Right? And so you start getting some critical mass on the back of that. I think that's one way to approach it.
So to end with a fun question, Piyush, I mean, you've talked about digital infrastructure a lot, and Singapore has done so well in building physical infrastructure, and you're making a case that Singapore should be the leader in building digital infrastructure. Would you be the leader who actually leads Singapore into that and join the public sector?
Yeah, I retired. I retired for a reason, Caesar.
On that note, thank you so much.
Thank you.
Thank you, Mr. Gupta and Mr. Sengupta. Please stay on the stage for a photo. May I now invite IPS Director, Mr. Janadas Devan, to give his closing remarks. Director, please.
We've come to the end of his lecture series. Allow me to thank Piyush for delivering his illuminating series of lectures. Through the 3 lectures, he has deepened our understanding of how Singapore's financial system has grown into a core pillar of the economy. In his first lecture, he traced Singapore's journey from the creation of the Asian dollar market and the 2-tier banking system to the subsequent development of Singapore as the leading foreign exchange and capital market center and a hub for asset and wealth management. The second lecture, he examined how digital technologies, new entrants such as fintech and digital banks and embedded finance have redrawn the financial landscape. Finally, in today's lecture, he turned to the opportunities and trade-offs that will shape the next decade. I agree with the moderator today, Mr. Sengupta, that this is the most consequential of your lectures, and I await with interest what the policymakers might make of this. And I think there were lots of suggestions in the lecture that certainly bear study. He asked what role Singapore can play as a global financial hub and what it must do in regulation, market development, and capability building to maintain our relevance. I love, in particular, one sentence you threw away. Singapore is small enough to be nimble, but big enough to matter. If I were in the newspapers, that might possibly be the quote from today's lecture. I would like to thank everyone who has been involved in making this past year's IPS-Nathan Lecture series a success, including each of Mr. Piyush's moderators for his 3 lectures, Teo Swee Lien for the first, Vikram Khanna for the second, and today, Mr. Caesar Sengupta. And of course, Piyush Gupta himself. Many decades ago, actually 5 decades ago, I was a student of economics and statistics. This was 50 years ago. And this was before the word digital existed. And we didn't have personal computers. I remember having to punch cards and feeding them into mainframe computers, and then you had to wait 24 hours to get an answer to a very simple question. After my first degree, I went on to do something which I thought was more interesting than economics and statistics, which was literature. listening to today's lecture, especially the third lecture, I'm not so sure whether I would make the same decision now, because listening to you, economics, or especially finance, I should say, sounds more fantastical than Alice in Wonderland, and more magical than magical realism. So I might well have stayed in finance or economics if I were a student today. As we conclude the 17th IPS lecture series, I would like to announce that our 16th IPS-Nathan Fellow, Mr. Philip Yeo, his book will be launched next March. We look forward to the launch of this book, titled Neither Civil Nor Servant, that describes Philip, Singapore's disruptive economic playbook. We also will look forward to welcoming our next IPS-Nathan Fellow, which is the former president of Nature Society, who won't have anything to do with finance, Dr. Sean Lam. Besides the ongoing IPS-Nathan lecture series, we are also having the second iteration of what's called the S.R. Nathan Fellowship's Young Leaders Seminar Series next February. And the series invites young academics and opinion leaders to present their existing research or new ideas. Our next such fellow will be Dr. Raina K. Jin Tan, who's assistant professor and lead of something called the Courage Lab at the Saw Swee Hock School of Public Health. He will be presenting his insights on youth mental health in Singapore. So we hope to continue the good work of the S.R. Nathan Fellowship and invite all of you to attend these future lectures and seminars. So thank you all very much, and thank you very much, Piyush, for an incredible series of lectures. Thank you.
Thank you, Director. We've come to the end of today's lecture. We'd like to hear your views on the event. Please click our link on the Facebook feed or scan the QR code on the screen to submit your feedback. Thank you all for attending today's lecture. Have a good evening ahead.